The last reported closing price for SoFi Technologies Inc, ticker symbol SOFI, on the NASDAQ was $26.54 on Friday, October 17, 2025, with an intraday movement of minus 0.06, representing a minus 0.23% shift for that session. The market is now closed, so that figure stands as the most recent point of reference for where investors see this company resting as we head into the next trading week. What the closing price doesn't immediately tell you, and what the street consensus often misses, is that the marginal pressure on that Friday close was less about internal company performance and more about a subtle but persistent rotation out of higher growth, higher volatility names within the financial technology sector, especially as institutional managers tweak their weightings ahead of what is shaping up to be a tighter than expected earnings cycle across the broader tech landscape. The expectation for SoFi stock has generally been a straight-up growth narrative, the Fintech disruptor story that captured so much attention when the stock ran up significantly over the past year. But the reality in the trading pits is that the market is now demanding a different kind of growth: profitable, sustainable, and less reliant on high-interest loan origination, which is exactly where SoFi's operational pivot towards its bank charter and technology platform becomes the critical yet underappreciated factor. The general belief about SoFi is that it has successfully transitioned from being just a student loan refinancing shop into a genuine one-stop-shop digital financial institution. This perception is well-earned, given the company's remarkable growth in both members and products, boasting numbers that continue to impress quarter after quarter. Yet the deeper reality is that this stock's daily movements are increasingly being controlled by a tension between two distinct investor camps. You have the long-term holders, who are focused on the rapidly scaling Galileo and Technesis tech platforms, and the inherent cost of funding advantages provided by the bank charter, which allows SoFi to internally finance its loans with lower-cost customer deposits instead of relying solely on wholesale funding markets. Then you have the macro traders, who view SoFi predominantly as a rate-sensitive lending stock. When the chatter around interest rates, credit quality, or recession risk picks up, the selling pressure on SoFi stock can become disproportionate to any specific company news. This is why you see days where a general sector slowdown, even if unrelated to digital banking specifics, can cause the stock to lag, despite the company itself announcing positive operational milestones like the recent rollout of Options Level 1 trading for its SoFi Invest members, expanding its suite of tools that competes directly with platforms like Robinhood and Interactive Brokers. The latest institutional activity reports confirm this mixed sentiment, showing strong accumulation from some of the largest asset managers like Vanguard and BlackRock, who are building long-term core positions, juxtaposed with aggressive selling or trimming from hedge funds, which are more susceptible to quarterly volatility and macro hedges. Looking at the immediate past, the daily swings in SoFi stock has been particularly volatile in the run-up to its next earnings call. The stock has been trading in a relatively tight but active band between $26.01 and $26.92 in recent sessions. The trading volume has remained elevated, often well above its three-month average, which signals a continued high level of interest and conviction on both the buy and sell sides. This heightened volume is characteristic of stocks experiencing a major narrative shift. The market is trying to figure out if it is still valuing the company on its old high-growth loan-centric metrics or on its new valuation as a deposit-funded integrated fintech powerhouse. When SoFi reported its second quarter 2025 earnings, the positive reaction was undeniable. The company beat expectations across the board, posting record net revenue and substantial growth in both members and products, reinforcing the story of its successful pivot towards a more diversified business model. Specifically, the acceleration in fee-based revenue, which includes income from its investment, checking, and savings accounts, as well as its technology platform services, was a huge green light for those advocating for the long-term structural change within the business. This is the structural reality that the price volatility sometimes obscures. It's an affirmation of the financial services supermarket model, the idea that you get a customer in with one product, like a personal loan or a student loan refinance, and then cross-sell them on services like a high-yield savings account or a SoFi Invest brokerage account for self-investing. The sector momentum has been a headwind at times, particularly with the overall pressure on regional banks and the broader Fintech 2.0 group, which is now facing a challenging interest rate environment globally. When you look at comparisons across the financial sector, a traditional bank is valued very differently than a tech-enabled growth company. SoFi, by having a bank charter while maintaining the high-growth profile of a tech stock, exists in a unique and often misunderstood middle ground. Companies like Fidelity and its various investment offerings, including Fidelity Investments, Fidelity ETFs, and Fidelity Mutual Funds, are mature institutions with established, low-cost capital bases and immense scale in wealth management. Robinhood, with its Robinhood stock trading and Robinhood app functionalities, is primarily a trading platform focused on online investing and fractional shares. SoFi is attempting to do both: capture the youth and digital-first demographic like Robinhood, while building the complete financial infrastructure and low-cost funding of a bank like what underpins the offerings of Fidelity Brokerage or even the Schwab Intelligent Portfolios. The market is often quick to sell the stock on general financial sector fears, while often being slow to fully price in the intrinsic value of its technology division, which provides critical processing infrastructure to a wide array of financial and non-financial companies. This dichotomy is what makes SoFi stock fascinating, but also subject to rapid price swings that defy simple explanation. The focus needs to be on the internal fundamentals, which continue to show a company executing on its strategy. So, what exactly is SoFi? It's a bank holding company that operates a mobile-first, comprehensive suite of financial products. Its business model is fundamentally designed around three distinct yet deeply interconnected segments: the lending segment, which is its historical core with student loan refinancing and personal loans; the financial services segment, which includes its checking and savings accounts, credit cards, and SoFi Invest platform, which is a significant tool for online investing and self-investing; and finally, the technology platform segment, powered by Galileo and Technesis, which is a B2B business providing payment and account processing infrastructure for other financial and non-financial businesses. The synergy between these three parts is the core thesis of SoFi. They use the low-cost deposits from the financial services segment to fund the lending segment, which increases profitability, and the technology platform provides a scalable in-house advantage that keeps their operational costs significantly lower than legacy banks. Past performance over the last 2 years clearly demonstrates a shift in revenue mix, with fee-based revenue from the technology and financial services segments gaining significant ground relative to the lending business, making the overall business model less susceptible to volatility in interest rates and more predictable. This strategic shift is what allows it to compete with the sheer scale of platforms managed by companies like Interactive Brokers or the vast product offerings of Fidelity Wealth Management. The immediate future outlook for SoFi stock centers heavily on two key areas: the upcoming earnings report and the broader interest rate environment. The market expectation is for continued but normalizing growth, reflecting a general slowdown in the tech sector. The reality that could exceed expectations lies in the profitability metric. The consensus is looking for a strong move towards consistent GAAP profitability. If the company can not only hit, but substantively beat its guidance on net income, it will force a significant re-rating by the street, pushing the narrative away from being a growth-at-all-costs fintech towards being a legitimate, profitable financial institution. The core catalyst here is the continuing reduction in their cost of funds, thanks to the massive influx of member deposits. As more customers use SoFi for their daily banking and online investing needs, the funding cost for their loan book drops, and that margin increase flows directly to the bottom line. This is a structural tailwind that few of their pure-play fintech competitors possess. The new offering of options trading is another step to increase user engagement and attract more active traders from platforms like Robinhood stock trading, boosting the high-margin, fee-based revenue. However, the risks are substantial and need to be acknowledged, reinforcing the tension between the ideal growth expectation and the market's reality. The biggest risk remains credit quality. In an environment where the economic outlook is uncertain, any noticeable uptick in loan defaults in their personal loan or student loan books would immediately spook the market and overshadow all the positive news from the tech platform. Furthermore, the valuation remains elevated relative to traditional banks, meaning that the market is still pricing in significant future growth. If this growth decelerates more sharply than projected, even if the company remains profitable, the stock could suffer a pullback simply on valuation compression. Regulatory pressure is also a constant factor in the financial sector. Any new government oversight targeting digital lending practices or consumer data security could impose unforeseen costs and slow down product expansion, challenging long-term SoFi investment thesis. The competition is fierce, coming not only from traditional players like Fidelity with its broad range of Fidelity IRAs and Fidelity mobile app functionalities,